Students, today's session is regarding national income aggregates. National income aggregates and concepts. Yes, in ISC exam from this chapter you can get some questions. This is quite important. This is very important. By the way, the next chapter, that is in national income block, the next chapter, which is methods of measuring national income, you'll be able to solve the numerical sums, which is a must, because numerical sums from national income estimation is compulsory. That will be coming for sure. Now, in order to do those sums successfully, correctly, you need to have a very good idea, very good knowledge about these national income aggregates and concepts. Firstly, domestic product or domestic income is defined as the value of all final goods and services produced by all the enterprises located within the domestic territory of the country. So domestic income is the sum total of factory incomes generated by all the production units located within the domestic territory of the country during a particular year. Whereas national product refers to the amount of final goods and services produced by the normal residents of the country during a year, whether they are operating within the country, whether they are operating within the country or outside the country, everything is taken into account in case of national product. There lies the significant difference between domestic product and national product. In case of domestic, when we emphasize on the word domestic, here we consider the values of the goods and services, final goods and services, which are produced within the domestic boundary, domestic territory of the country. When we consider national product, we consider all the values of all final goods and services which are produced by the normal residents of the country, normal citizens of the country during a year. Now, whether they are operating within the country or outside the country, everything will be taken into account. Okay. Now we come to the national product at market prices. National, by the way, before that, national product is equal to domestic product plus net factor income from abroad, which we all say NFIA, net factor income from abroad. Now, what is this NFIA or net factor income from abroad? Net factor income from abroad is equal to factor incomes of domestic factors working abroad, that means factor incomes from abroad, minus factor incomes of foreign factors working within the domestic territory, where it is factor incomes going outside to abroad. So factor incomes from abroad minus factor incomes to abroad is equal to net factor income from abroad. So national product is equal to domestic product plus net factor income from abroad, that is NFIA. Now, national product at market prices and national product at factor cost. See, when we consider national product at market prices or national income at market prices, it is the value of all final goods and services produced by the normal residents of the country during a year, calculated at their market prices, when the values are taken based on the market prices of the goods and services. Whereas when we take national income or national product at the factor cost, it expresses national product accruing to the normal residents of the country, received by the normal residents of the country during a year, when the sum total, we take the sum total of all the factor payments. Factor payments, here the values are taken based on the factor payments, the costs of different factors, wages and rent, interest and profit, that is all factor payments. Now, when we convert the conversion rule from factor cost to market price, from factor cost to market price, how do we go? Any value at factor cost to the value at market price. How do we go? The value at factor cost plus net indirect taxes is equal to the value at market price. Now, what is that net indirect taxes? Net indirect taxes is equal to indirect taxes minus subsidies. Indirect taxes minus subsidies. Then we get net indirect taxes. Thus, national product at factor cost plus net indirect taxes is equal to national product at market prices. Now, if we have to go in the opposite direction, suppose from national product at market prices to national product at factor cost, we will do the opposite. That means national product at market prices minus net indirect taxes is equal to national product at factor cost. Remember, net indirect taxes is equal to indirect taxes minus subsidies. Okay. Now I will tell you about 3 rules here. 3 rules from any gross value to any net value when you will convert. Like we have the basic 4 concepts: GDP, GNP, NDP, NNP. Gross domestic product, gross national product, net domestic product, net national product. From gross value to net value when we convert, what we do? Gross value minus depreciation is equal to the net value. So GDP minus depreciation is equal to NDP. Any gross value minus depreciation is equal to the net value. Now GNP minus depreciation is equal to NNP. Now here, in case of the sums in the next chapter when we will do, instead of the term depreciation, they may give you consumption of fixed capital. That consumption of fixed capital is nothing but depreciation. Okay. Now GDP at market price, gross domestic product at market price, is the market value of all final goods and services at the prevailing market prices produced in the domestic territory of a country during a particular year. Now gross national product at market prices, GNP/MP, is the total value of all final goods and services produced by normal residents of the country in a year, inclusive of depreciation. In case of gross national product at market price, GNP/MP, that is defined as the market value of all final goods and services produced by the normal residents of the country during a year, inclusive of depreciation. Now in case of GNP, here we will consider even the net factor income from abroad. Therefore, GDP plus net factor income from abroad is equal to GNP. Okay, domestic to national. How do we go? Domestic to national, we convert domestic value, any domestic value like gross domestic product, plus NFIA, net factor income from abroad, we get GNP, gross national product. So domestic value to national value, we convert by plus NFIA, net factor income from abroad. Next is NDP, net domestic product at market price. It is the market value of all final goods and services at the prevailing market prices produced by the residents of the country in the domestic, within the domestic territory, within the domestic boundary or territory of the country, after making allowance for depreciation. Because after making allowance for depreciation, if you are given define net domestic product, then you have to write at the end this after allowing for depreciation. Now in the same way, when we consider net national product, see, from GNP to NNP, GNP to NNP, again gross to net, gross national product to net national product. How do we convert? Gross to net, so minus depreciation, minus consumption of fixed capital, we get the net value. So net national product, NNP/MP, that is the market value of all final goods and services produced by normal residents of the country during a year after making allowance for depreciation. Thus the rules for conversion, it's very, very important. If you remember the rules, that's significant, that's very important, because they can give even fill in the blanks. Sometimes in the past they had given fill in the blanks also for conversions. Now we have learned 4 concepts, 4 basic concepts: GDP, GNP, NDP, NNP. Each of these 4 can be of 2 types: GDP at factor cost, GDP at market price; GNP at factor cost, GNP at market price; NDP at factor cost, NDP at market price, and also NNP at factor cost, NNP at market price. Out of these eight concepts rather, because four basic concepts, each of these four is of two types, factor cost and market price. Then out of these eight concepts, NNPFC, net national product at factor cost, it is considered as national income. That is the national income, NNPFC. So if you know the rules of conversion, then you can calculate, you can convert all these. After this, I will go to the next concepts. Now the next concept is transfer payments. Transfer payments are the payments which are received without any contribution to the current output. Now it can be a current transfer, it can be a capital transfer. A current transfer is that transfer which is made out of the current income of the payers and adds to the current income of the receivers. Current transfer is that transfer which is made out of the current income of the payers and adds to the current income of the receivers. Capital transfer is that transfer which is paid out of the capital or wealth of the payers and adds to the capital or wealth of the receivers. So this can be a short question. What is the difference between current transfer and capital transfer? Remember, current transfer means when the transfer is made from the current income of the payer and it adds to the current income, current receipts, current income of the receivers. In case of capital transfer, it is that transfer which is made out of the capital or assets of the payers and it adds to the capital or wealth of the receivers. Okay, now next concept is what is disposable income? Income inclusive of all current transfers is called disposable income. Income inclusive of all current transfers is called disposable income. So disposable income, you can remember like an equation. Income plus net current transfers is equal to disposable income. The income plus net current transfers, we get disposable income. Now, national disposable income. What is national disposable income? National disposable income is defined as the sum total of national income at market prices and net current transfers received from the rest of the world. Now, if in a question of numerical sum also in the next chapter which we will do, if it's given calculate national disposable income, then how to calculate? National disposable income is the sum total of national income and market prices, national income and market prices, and also with it we add net current transfers received from the rest of the world. The net current transfers from the rest of the world. So while calculating national disposable income, we take national product at market prices as the relevant national income aggregate. Now, gross national disposable income is equal to GNPMP plus net current transfers received from rest of the world. GNPMP plus net current transfers from rest of the world. Then we get gross national disposable income. In a similar manner, net national disposable income is equal to net NNPMP plus net current transfers received from rest of the world. So you need to be careful what it is asked. If it is asked gross national disposable income, then GNPMP plus net current transfers from rest of the world. If it is asked net national disposable income, then NNPMP plus net current transfers received from rest of the world. Okay. Now we come to private income. What is private income? Private income is the total of factor incomes including retained profits of the corporations, that is the private companies, from all sources and the current transfers from the governments and rest of the world accruing to the private sector. Accruing means received by the private sector. Whatever income, the total income earned by, received by the private sector in the country, that is private income. Now, how do we get private income from national income? How do we get private income from national income? You can remember it in the form of a simple equation. National income minus income from property and entrepreneurship received by the government. The income from property and entrepreneurship which is going to the government commercial enterprises and administrative departments. That means all incomes which are received by the government enterprises, government sector enterprises, and also government administrative departments. That means the income earning of the government departments and also the enterprises, commercial enterprises and administrative departments, minus savings of the non-departmental enterprises of the government, savings by the non-departmental enterprises of the government, plus interest on national debt. Interest on national debt is earned by the private income, but it was not there included in the national income, so you have to add that. Plus interest on national debt, DEBT debt. That means the government had sold bonds to the common people, that is the private individuals. Now the private individuals will be earning interest on that. That is interest on national debt, plus net current transfers from the government, plus net current transfers from rest of the world. I repeat the whole equation. Yes, not a very short equation, it's quite a lengthy equation, but it's easy. Private income is from the national income. If we deduct all incomes going to the government enterprises and administrative departments, and also deducting the savings of the non-departmental enterprises of the government. Now these two are deducted. What are added? Plus interest on national debt, plus net current transfers from the government like pension, scholarship, these, plus net current transfers from abroad, from rest of the world, from abroad. So that is private income. Yes, this can be a probable question. What is private income? And how is private income derived from national income? Next is personal income. Personal income is the total income received by the persons, individuals or persons, from all sources in the form of factor incomes and also current transfer payments during a year. That means the total income earning of all the persons or individuals in the country, and also as in the form of factor incomes and also the current transfers during a year. That is personal income. Then question can be, what is personal income and how do we get personal income from private income? So private income minus undistributed profits, whose undistributed profits of the corporations, of the corporate sector companies, that with the private sector enterprises, minus corporate profits tax, which is given by the private enterprises to the government, corporate profits tax, because that is part of the profits earned by the private companies, minus retained earnings of foreign companies. Not only we have to consider the profits earned by the domestic companies, domestic private enterprises, but also we have to consider the retained earnings of foreign private companies. We have to deduct that also, subtract, minus contribution of enterprises towards social security schemes, because from their earnings the private companies are paying, or they pay the social security contribution they pay to the employees. So this is also to be deducted or subtracted. Thus private income minus undistributed profits, minus corporate profits tax, minus retained earnings of foreign companies, minus contribution of enterprises towards social security schemes. So this is how we get personal income from private income. The next one is personal disposable income, DPI, that means disposable personal income or personal disposable income. Personal disposable income is that part of the personal income which is available to the individuals to be used the way they like. That means they can spend that money for consumption purpose and also they can save. So personal disposable income is equal to personal income minus personal taxes paid by the people, by the persons, minus miscellaneous receipts of the government administrative departments paid by the households or common people. I repeat, personal disposable income or DPI, disposable personal income, is equal to personal income minus personal taxes minus miscellaneous payments paid by the households to the government administrative departments. Yes, another thing, this personal disposable income or disposable personal income can be viewed from another angle. I said already that disposable personal income or personal disposable income is that part of their personal income which the people can spend either for consumption or saving, or both consumption and saving, consumption expenditure and saving. So we can write personal disposable income is equal to consumption expenditure of the households or common people plus the household savings. Consumption expenditure plus savings. So these are the very important national income aggregates and concepts. Now, another very important concept will be nominal GDP and real GDP. First, nominal GDP, that means GDP at current prices, that is the total value of all final goods and services produced by all the enterprises located within the domestic territory of the country during a particular year. That is the definition of GDP. Expressed at the prices, market prices prevailing in a particular year, in that particular year, that is nominal GDP or GDP at constant prices. Whereas when we consider GDP at constant prices, that was GDP at current prices, now we consider GDP at constant prices, which is called real GDP. Real GDP is GDP at constant prices. This is the total value of all final goods and services produced by all the enterprises located within the domestic territory of the country during a particular year and expressed at the market prices prevailing in a particular previous year, which is considered as the base year. That previous year is considered as the base year. So based on the prices of the goods and services which prevailed in that particular base year, when the market values are taken, the market prices are taken, then that total summed up value, that is called real GDP or GDP at constant prices. Now relating these two, GDP at constant prices and GDP at current prices, that means real GDP and nominal GDP, there's a particular formula. So we can express that formula. You have to remember that formula. GDP at constant prices, that is real GDP, is equal to GDP at current prices divided by price index number of the current year, price index of the current year into 100. GDP at current prices divided by price index of the current year into 100. That is the real GDP. Now, apart from these all, in this chapter, national income aggregates and concepts, there is one more topic, whether GDP or national income can be considered as a true measure, as a good measure of economic welfare of the people in a country. The answer is no. No, national income or GDP cannot be considered as a true indicator, as a good measure of economic welfare of the people in a country. See, economic welfare, what is economic welfare? It refers to the material well-being of the people. Economic welfare means the total satisfaction or total utility derived from the use of goods and services that can be purchased by money. That is economic welfare. Now you may think that GDP is increasing, national income is increasing, then surely there will be increase in economic welfare. May not be. There are several limitations. There are several limitations or reasons why GDP or national income should not be considered as a true measure of economic welfare of the people of the country. First reason, GDP may increase, national income may increase if some people of the country who were already rich, they are becoming richer, and some people, or many people who were poor, are becoming poorer, but still the national income or GDP is rising or increasing. Then if this happens, then the income inequality increases. There will be more income inequality in the distribution of income, which is not a good sign of economic welfare of the overall entire country, or the people, overall people of the country. Secondly, composition of the output is also a factor. Suppose if the production of, domestic production of, or production of harmful goods, narcotics, intoxicants, intoxicating goods, arms and ammunitions, these type of things, these are some examples which I've given. The production of these, cigarettes, alcohol, these type of goods production has increased. Then also GDP will increase. Then also national income will increase. But that does not imply that there will be economic welfare of the people of the country, because these are harmful goods production. Next is another point is expenditure on regrettable necessities. This is another point which highlight the limitation. There are some expenditures which are forced on the consumer. Such expenditures are called regrettable necessities. Expenditure on transport to reach the place of work, expenditure on medical treatment because of pollution in the cities, etc., are the examples of these expenditures on regrettable necessities. All such expenditures are included in GDP, but they do not increase the economic welfare of people. If people, after working hard, they are earning money, good amount of money, GDP increases, income increases, but in order to earn that increased income, while working hard, they are falling sick and they have to make treatment for that, and the expenditure which is incurred by the people on that treatment is not considered here, is not taken into account. We should. Then we can say, just taking into consideration the value of the GDP increase or the national income increase, we should not, because here the treatment expenditures, or while earning, the person has to, while working and earning, for working and earning, the person has to travel a lot, travel a long distance, and for that the transportation cost is quite a huge amount. Then we do not consider that. We consider only the income earning. Okay, next is the manner of increase in the GDP. Economic welfare depends on the manner in which increase in the GDP occurs. If increase in the GDP is a result of longer working hours, quite painful, increased employment of child labor force, or unhealthy and polluted atmosphere in the workplaces and the factories, natural resources are overexploited, overused, there will be increased environmental pollution, then if these things occur, these are not good signs of development of the country. These are not good signs for the economic welfare of the people of the country. So if these occur and then there is increase in the national income, there is increase in the GDP, we cannot say that GDP has increased, so it implies, it reflects that people of the country are having more economic welfare. Now another point is why GDP or national income cannot be considered as a good measure of economic welfare, is that there are some exclusion of some items from the GDP. We exclude those items, like we exclude leisure, L-E-I-S-U-R-E, leisure. One of the factors affecting economic welfare, or people need leisure in life. If people go on working hard and hard, there may be a time when they fall sick or they get too much exhausted and tired. Then people are not happy, they do not relax at all. Then where's the use of that working hard? Yes, they are earning more, but for that they are sacrificing the leisure, they are sacrificing the relaxation time. Then this is some particular factor which is not considered in the GDP or national income accounting. Next is the non-market transactions. Some of the non-market transactions increase economic welfare, but they are not included in GDP. Non-market activities refer to those activities on the goods and services which are not exchanged in the market at market prices, like services of the housewives. The services of housewives, are they paid? Are the housewives paid? No. The housewives are not paid. But see, these are not non-market activities. But from the services of the housewives, are the members of the families, they get benefits. There is economic welfare from the service of the housewives. But unfortunately, the housewives are not paid. Thus, GDP does not consider anything, does not involve any payment for the housewives. Then, GDP does not include any payment of the housewives, whereas we find the housewives' activities are helping the people of the family to get more welfare. Right? So, these are the points which we can highlight here as limitations why GDP or national income cannot be or should not be considered as a true measure or a good indicator of economic welfare. So that is the chapter National Income Aggregates and Concepts. In the next session, I will discuss about a very, very important chapter, and that is estimation of national income, methods of calculation of national income, along with the precautions, which is also tremendously important. Thank you.